Since 1929, the Dow Jones Industrial Average has recorded 25 official bear markets, suffering peak-to-trough declines averaging 36%. The US dollar, over the same period, has lost 97% of its purchasing power against gold. Global public debt now exceeds $300 trillion, a $100 trillion increase in the last decade alone. Yet, across this century of crashes, currency debasement, and systemic reboots, only 3 distinct asset classes have demonstrably preserved and multiplied real capital through every cycle: war and inflationary spike. The paradox is that these assets are often dismissed by modern finance for their illiquidity or perceived lack of yield. Their primary function is not income generation, but terminal structural integrity. They are the instruments of last resort. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. The financial survival toolkit is smaller and sharper than you think. To understand this, we need to start earlier. The period between the 1929 crash and the formal end of the Bretton Woods system in 1971 serves as the foundational laboratory for true crisis assets. The scale of the Depression was not merely a market correction. It was a systemic implosion of the credit structure built in the 1920s, a 90% decline in the Dow, and a collapse in global trade. The response was not smooth. The U.S. government, under President Roosevelt, effectively nationalized gold in 1933 via Executive Order 6102, forcing citizens to sell their gold at $20.67 per ounce, only to reprice it at $35 an ounce the following year. This was a 41% devaluation of the currency against its historical anchor. Those who possessed physical, non-monetary gold, jewelry, specialized coins, or hoarded bullion outside the banking system suddenly found their wealth revalued overnight against the dollar. The numbers told a different story. The move revealed the structural risk of any asset whose value is primarily determined by a sovereign guarantee. The guarantee is subject to the sovereign's existential needs. Asset Class 1, physical gold, is sprung. It survived because its ultimate counterparty risk is zero. It is an atomic element. It cannot be inflated away by fiat printing, and its legal possession, while challenged in 1933, returned to favor after the immediate crisis passed. This was the real shift. The next major test was World War II, which introduced a level of capital destruction and controlled economies unprecedented in modern history. Inflation soared, driven by wartime financing and materials shortages. Germany, the UK, and the US ran massive deficits. In the UK, the national debt-to-GDP ratio peaked near 250%. Price controls were widespread, yet the demand for portable and traceable value exploded. Here, the utility of investment-grade diamonds and precious stones became evident. These assets represented condensed, non-bank intermediated value. They were small enough to transport across borders, high value enough to constitute significant wealth, and anonymous enough to bypass nascent capital controls. Unlike gold, which was targeted by governments as a monetary metal, diamonds were considered industrial or luxury items, flying just under the radar of state requisition and capital flight restrictions. During the European exodus, a significant portion of family wealth that successfully crossed the Atlantic did so in the form of these stones. They were the ultimate non-financialized bearer instrument. The final structural stress test of this era was the stagflationary crisis of the 1970s. The U.S. detached the dollar from gold in 1971, allowing the currency to float freely, leading to 2 decades of high inflation, peaking at 14.8% in 1980. This period was lethal to financial assets. Stocks were stagnant and bond yields lagged behind inflation, resulting in a devastating loss of real purchasing power. The average real return on the S&P 500 from 1968 to 1982 was negative. Asset Class 3 emerged as the most resilient anti-inflation hedge. Productive, non-leveraged agricultural land. Specifically, land-producing commodities essential for survival, such as grains, livestock, or timber. The value of this asset class is not tied to the stock market's valuation multiples or a central bank's liquidity policy. It is tied directly to the fundamental input cost of human life. As the price of grain and beef rose due to inflation and geopolitical shocks, e.g., the Soviet grain deal, the value of the underlying land and the cash flow generated from it rose proportionally or faster. The land's output price is inflation. Its capital value is a derivative of that price, and thus it provides a near-perfect hedge. The U.S. farmland values, for instance, saw strong growth throughout the 1970s, acting as a real capital sink while financial assets dissolved. Confidence became currency. The 3 assets, physical gold, investment-grade diamonds, and productive agricultural land, represent 3 distinct forms of capital preservation tested by 3 distinct crises: systemic credit collapse, 1929, total war and capital controls, W. Buplek, and currency debasement, 1970s stagflation. Gold is the monetary anchor rejected by the state but revered by the market. Diamonds are the non-sovereign bearer instrument of last resort. Land is the physical, consumable necessity that generates an inflation-linked cash flow. The combination of these three provides a portfolio that addresses all three terminal risks: counterparty failure, confiscation or transportability failure, and currency failure. The core logic of the financial historian's survival toolkit is rooted in this trio of failures and the assets that inherently solve them. They are not high-yield assets. They are failure-proof assets. The modern mechanics of systemic risk have changed in dimension but not in kind. Today, the crisis is not a collapse into deflation, but a deliberate engineered dependency on liquidity. Global debt to GDP now sits around 350%, and the scale of continuous refinancing has replaced the risk of outright default for developed nations with rollover risk. And confidence loops. Asset class 1, physical gold, maintains its structural significance precisely because it is the only reserve asset that is not simultaneously a liability of another entity. The modern system runs on sovereign debt, U.S. treasuries, Japanese government bonds, JGBs, German bunds. When China sells treasuries, it forces the Federal Reserve to intervene to manage the yield structure, demonstrating the political and institutional nature of fiat stability. Gold sits outside this loop. Central banks globally added over 1,136 tons of gold to their reserves in 2022, the highest on record, largely driven by nations like China and Turkey seeking de-dollarization and structural independence. This is not driven by yield. It is driven by the realization that in a conflict scenario or a hyperinflationary event, the only asset that is not frozen, sanctioned, or devalued by the issuer is physical gold held in a non-jurisdictional vault. The average annual volatility of gold is lower than the C&P 500, but its core value is realized only when the systemic correlation of all financial assets approaches. 1. A state known as flight to quality. Confidence decides who survives. Asset class 2, investment grade. Diamonds, or precious stones, has adapted its role from a bearer instrument for wartime refugees to a capital flight mechanism for the modern oligarch and the financially repressed. While bulk gold moves on central bank balance sheets, high-end stones move through private wealth structures. Consider the case of capital flight from China, where annual outflows are estimated to be in the hundreds of billions of dollars. Large liquid financial centers impose strict reporting requirements. Moving $10 million in financial instruments is traceable. Moving a comparable value in a handful of flawless, GIA-certified diamonds is exponentially simpler, falling under different customs and anti-money laundering regulations due to their luxury classification, not monetary classification. The institutional incentive for a sophisticated high net worth individual is to diversify counterparty risk away from their home country's banking system and regulatory structure. The secondary market for these stones is tight, illiquid, and opaque, precisely the features that make them attractive for wealth preservation, as they resist immediate financialization and therefore state surveillance. They are value density weaponized against capital controls. The illusion holds until it doesn't. Asset class 3, productive, non-leveraged agricultural land, has become the ultimate hedge against what is effectively structural inflation baked into the modern monetary framework. Developed nations like the US and the Eurozone are using fiscal deficits, such as the $2 trillion spending packages post-2020, to monetize debt, leading to price level increases that are persistent, even if volatile. Farmland value in the U.S., particularly for corn, soybean, and cattle production, saw double-digit appreciation in the early 2020s, significantly outpacing the nominal growth in equities. This is a direct consequence of the Powassan liquidity dependencies of the current system. When the central bank prints to maintain bond market stability, and that newly created capital flows into real assets, inflating the price of the factor of production, the land. Furthermore, land is a political asset essential for food security. Governments will often subsidize its use and protect its ownership, even during periods of deep financial crisis, ensuring its terminal utility. This contrasts sharply with commercial real estate, or residential housing, which are cyclical, leverage-dependent, and prone to interest rate shocks, as seen in the 2008 U.S. housing crisis or the current Chinese property debt crisis, where over $300 billion in liabilities are effectively frozen. Agricultural land, when purchased outright without a mortgage, is immune to refinancing dynamics. Markets enforce what politics avoids. The capital invested is exchanged for the perpetual right to an essential inflation-linked cash flow. The three assets survive because they are fundamentally non-financial liabilities. The contemporary threat landscape is defined by two interconnected features: instantaneous technological contagion and geopolitical fracture. The speed of a modern financial crisis, accelerated by algorithmic trading and social media, means that a 36% decline in an index can occur in weeks, not years, demanding assets with inherent immediate structural value. The first asset, physical gold, retains its position as the ultimate counterpoint power asymmetry ice balancer. In an era of escalating sanctions and reserve weaponization, exemplified by the freezing of Russian central bank assets, the location and ownership of gold become paramount. The recent movement of gold from Western vaults to emerging market centers highlights the flight from counterparty risk. The specific gravity of gold, its extreme value to volume ratio, is not merely an economic feature, it is a strategic feature. A ton of gold valued over $70 million at current prices takes up less than a cubic meter of space. This density is what provides political optionality. What cannot be repaid will be rolled over, but what can be instantly seized will be moved. The modern portfolio allocates to gold not as a trade, but as an insurance policy against institutionalized theft by the state, or more simply, the loss of reserve status by the incumbent currency. Asset Class 2, investment-grade diamonds and precious stones, operates in the shadow economy of high net worth, a parallel structure distinct from the heavily regulated mainstream banking sector. The illiquidity, often cited as a weakness, is, in fact, the source of its systemic stability. Unlike publicly traded stocks or corporate bonds, a diamond's price is not subject to daily mark-to-market risk. Its valuation is derived from established scarcity, quality metrics, the 4 Cs, and historical pricing stability, which insulates it from the panic-driven liquidity spirals of financial markets. Furthermore, the global diamond trade, while structured, often operates outside the core institutionalized financial network. For those facing immediate sovereign risk, such as entrepreneurs in politically volatile jurisdictions like Argentina or countries with arbitrary wealth taxes, the ability to store and move immense value through a non-financial conduit is non-negotiable. Diamonds are not merely store of value. They are jurisdictional escape velocity. Materialized. Their value is enforced by a global fragmented network of specialized dealers, not a single central bank or government. Asset Class 3. Productive, non-leveraged agricultural land, is now a central component of sovereign wealth fund strategies and institutional endowments, confirming its non-speculative strategic utility. The focus has narrowed to genuinely high-yield staple crop producing regions, such as the U.S. Corn Belt, specific tracts of South American terra firme, and key European grain producers. This asset class functions as an inflation hedge and a crucial risk mitigant against supply chain fragility. Global food supply chains have been repeatedly tested by pandemic disruptions, the Russia-Ukraine conflict, and climate volatility. The owner of the land owns the physical production capacity, bypassing the complexity and cost of logistics and geopolitical blockade. Furthermore, with the accelerating global population, the input of land per capita is a decreasing metric. Land is a non-replicable, finite factor of production. Its value is not a function of fractional reserve banking or quantitative easing, but of fundamental geology and utility. In an environment where major central banks like the Bank of Japan continue to hold interest rates near zero, effectively nationalizing the bond market to manage $7.5 trillion in JGBs, the real return on any yield-bearing financial asset is a systemic lie. The land generates a real yield, a crop, that is independent of the sovereign's credit rating. The three assets are not a portfolio for maximizing paper returns. They are the ultimate financial life raft, designed for the moment when paper returns cease to matter. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.